I wanted to look at 5 big ideas that are in the ultra growth space. So can you tell us maybe a couple of really strong ideas that you think project well into the future, and maybe a couple of ideas that have floated around for a while and haven't really paid off for people?
Yeah, I mean, there's some really interesting stuff going on in the life sciences. And it gives you examples of both, of things that like really cool technology that didn't quite work out the way people expected, and stuff that did much better. So the example would be kind of gene editing and CRISPR. So a huge amount of buzz, really exciting. The idea that you could potentially go into someone's genome, change a few things, and cure a horrible disease. There's actually, before CRISPR, there were many ways of doing this. You could use viruses. You could use things called zinc fingers. There are multiple ways of doing that. It was very hard to bring these treatments to market, because what you're doing is you're changing people's DNA. And if you get it wrong, there's a good chance somebody might get leukemia or some horrific thing or some unpredictable side effect that we don't know.
And that has been the case.
And that has been the case. The first generation of the gene editing, most of the people in those first trials got leukemia. And these, even now, where it's worked, it's usually been tried in pretty horrible diseases. So the consequences of not being treated are so bad that it kind of allows you to kind of try these more experimental methods. What's really interesting is if you think about DNA, what happens, that's translated into mRNA, which then either makes a protein or blocks a protein or does something further down, which has the impact on the disease. So the most exciting part of biotech at the moment, in my opinion, is actually methods that play around at that step. So you're not changing the genome, you're just changing that layer between like the DNA and the actual protein, the actual effect of the disease. So an example of that would be Moderna. So Moderna, unlike CRISPR, which hasn't actually brought anything to market yet, Moderna's on track. They've got something like 19 billion of pre-orders, a 60 billion market cap. They are making money, they have delivered, and they're going to use that to then roll out and fund their entire pipeline. There's a bunch of other different ways of kind of affecting the outcome of disease at that same level. So if Moderna's doing mRNA, there's RNAi, which is like interference molecules. So you can actually get bits of DNA that block bits of mRNA.
I think at this point it'd be really useful for you to tell us a little bit about your educational background. I understand that you studied chemistry, is that right?
I did, yeah. So I studied chemistry at Oxford undergrad and then did a master's.
Yes.
And then kind of stopped there and joined the dark side in finance. For better or worse.
Tell me, if you hadn't become a fund manager, where would you be in your career? What would you have done?
Look, knowing what I know now, I would have probably done a PhD. So I stopped after the master's. I think doing the PhD would have been good. 3, 4, 5 years of focused study on one thing, learn the experimental methods. I think when I was 22 or 23, however old I was when I graduated, that seemed like an unimaginable long period of time, but it's just not. It would have gone like that. I often get emails and LinkedIn messages from people saying, how do I get from science to finance? It's kind of like stay. There's so much cool stuff going on in there. And amazing business opportunities that I wouldn't necessarily recommend anybody makes that jump. So I think, probably would have stayed in the scientific field.
Okay, interesting. And I think that, you mentioned age there, and it's quite unique to have a fund manager who, is very early stage of their career and doing really well for themselves. Have you found that your age has been sort of a disadvantage or a bit of a competitive edge in the market?
Look, I think it's just different to what most people are seeing. So if you go into a meeting and a young person rocks up, it could go either way. On the one hand, they've got less experience than a lot of other people. On the other hand, it's probably a bit more exciting, a bit more interesting. And I think most fund managers are investing in a very similar way. They're using the same tools, they're coming to the same answers around these core stocks, like should we be buying the Afterpays, Teslas, Netflix, or should we be selling them? And so there's a lot of, they basically come to the same kind of answers to those questions. If you come in with a different perspective, that can be really helpful. And a lot of funds are actually stuck in in their mandates. They can't actually change course. You can't actually go from being a deep value person to then, punting biotechs. It's not really a shift that you can make, nor should you really. You should probably stay in your area of focus. So that's actually created a pretty big opportunity for us, because the vast majority of money in Australia is not invested in the companies that we invest in. It's just, if anything, the opposite. And it's actually quite important that changes over time. So if you think about, we've got roughly 45, 50 stocks growing at 100%. These are large companies. They're like 10 billion plus market cap. They're not growing 100% in a vacuum. GDP is flat. They're growing at 100%. They're taking that revenue from somewhere else. And you can see this in action. You can see the entire auto industry stagnate as Tesla goes through the roof. Or banks lose tens of billions of dollars of value as Afterpay creates tens of billions of dollars of value. Sometimes you can actually see that in action. Or Shopify and e-commerce ripping like this, while physical retail and the physical spaces, the real estate, falling. So it's almost like a bit of a tragedy that so much of people's money is tied up on the losing side of all those equations. So I think it's really important over time, irrespective of what they think of us and what we're doing, that people do try and allocate more to this space and make sure that if you've got these rockstar companies growing 100% plus, you should be invested at least somewhat in those companies because they're doing that at the expense of someone else. Like it's just a mathematical identity.
So Michael, I want to learn a little bit about your investment philosophy. It's really unique. It's about true love and explosive growth. Now, what does that mean?
True love and explosive growth. Well, I think the genesis of that was we're trying to figure out, I think everybody in the investment world comes through the same kind of journey. They read the same books, they idolize the same heroes. It's all about free cash flow, buying 50 cents on the dollar, and people take pride in being a value investor, and all the language, everything that goes along with that. But the reality is the best investments of the last 10, 20, 30 years often didn't have any of those characteristics. In fact, they're the opposite. They're like losing money the entire way. These are things like Tesla, Afterpay, Netflix, more obscure companies like Carvana, software companies that didn't exist 10 years ago, now worth tens or hundreds of billions of dollars. So we're trying to figure out how could you actually identify those things early? Like what characteristics did those companies have, right at the beginning of their journey or, relatively early in their journey that could allow you to identify them and then invest in them and then hold them the whole way through.
And what is that? What are those qualities these companies have?
Yeah, well, I think to answer that question or to figure out how to kind of identify these early, you really need to start at the customer rather than, I guess, the financials.
So that's the true love component.
That is the true love bit, yeah. And I'll give you an example of how you can actually use that to identify the right company out in a complex situation. So think about when Apple launched the iPhone in 2009. There was a host of existing competition, Nokia, BlackBerry, Microsoft, huge balance sheets, a host of Asian competitors, old and new companies like Sony, LG, Huawei. But there was only one company that had people queuing outside stores, pitching tents, and really kind of obsessing about the brand, and that was Apple. And then over the next kind of 10 years, they're able to charge a few $100s extra per phone and created $2 trillion of equity value. Now, I've kind of told that story a few times, but if you actually really unpack, what was going on in 2009, 2010 was extremely complicated. You could have looked at all the strengths and weaknesses of each of those companies. You could have written a book about it. You could have updated that every quarter. Every product launch, there was a new reason to think that this company would do better than that company. But by sticking with the one that had that true customer love, you actually got the right answer the whole way through. And that was consistent for 10 years. And so that allowed you to firstly identify the right company out of all of them to own. And then secondly, give you that conviction, just hold it the whole way through. But there isn't that element of explosive growth as well.
Well, how do you measure that customer love though? Is it a matter of measuring the line out the door? Is it their marketing spend? Is it their earnings momentum even? Or is it too late by the time you hit that peak?
Look, I think for the companies that have it, it's very obvious. So I'll give you an example. In Australia, it would be something like Afterpay. So people were like Instagramming about that and getting all excited about Afterpay. Visa, MasterCard, PayPal, these companies have been around a long time. None of them built that community and had that excitement. And you see that often, something like Netflix. Think about the amount of time that people spend watching that, for years, like long before the stock, did what it did. It's user engagement, it's app downloads, it's web traffic. Everything should be pointing in the right direction. And you should also be hearing about it. People should be excited about the product. I think what you're trying to avoid with that customer love thing are brands that compete on price and features. That's kind of like what you want to try and avoid, because then you're getting this really complicated dynamic where you're trying to figure out which brand and which brand is going to win at that particular moment, in that particular iteration of their product. And that's a tough business. And typically what happens is the winner will have a slightly lower price or slightly better features, and they'll kind of lose money to kind of win there. But as a whole, those companies competing at that level will not make money. So to go back to the smartphones, all those smartphone companies generally broke even, and Apple captured the entire profit margin in the industry for years. There was a similar dynamic in cars. So autos, there's extremely powerful brands, Toyota, in Australia, Holden, Fiat. There's amazing car companies, they're good. They know how to build a car. They're extremely proficient. But a lot of them don't have any customer love. They're amazing global brands without customer love. They're competing on price and features. And, those stocks went nowhere for an extremely long time. It's because they could never actually capture that, extra economic value that they needed to. Obviously, Tesla was different. Elon Musk could generate hundreds of thousands of pre-orders with one presentation. and he charged more per vehicle. There's another car company with, I guess you could call it true customer love, and that's Ferrari. And Ferrari often traded at similar kind of EV sales as Tesla. So you can see the market really values that kind of customer love, and it does that because it translates into fundamentals. You can actually charge more, you can earn more.
Where does that love runway kind of end? How do you know when to let go of a stock that people have loved? Maybe it's an Apple. People have loved for a really long time. Where's the tipping point?
Yeah, look, I think for us, there's that explosive growth element as well. So we try not to have opinions about what's good and what's bad. We want to see it. We want to see it in the web traffic. We want to see it in revenue every quarterly update. The best companies should be adding users. They should be adding revenue per user. Every key KPI should be going in the right direction. And for us, it's pretty simple. I mean, our companies are growing at well over 100% on average. We'll hold them while they continue to do that, because the real returns come from compounding that over 2, 3, 4, 5 years and on. So our entire portfolio is kind of compounding at that rate, and we'll basically hold while they're doing that. So to use again an example everyone knows, Afterpay, they maintained at 100% growth for, I guess, 6 or 7 years now. The right call was to hold it while it was doing that. Even though there was extremely bumpy ride in the stock, sometimes it was 30% too high or 30% too low or 50% too high or 50% too low. The real game was getting that 100%, 100%, 100%. And that's kind of what we try to do. So while the company is performing, we'll generally hold.
One of the things that you've said to us before is that the data is more important than the management to a company, which is, I guess, not the usual sort of thesis. Can you tell us a little bit about what that means to you and what kind of data points do you look at?
Yeah, sure. I mean, I think a lot of fund managers talk a lot about access, access to management and kind of the insight you can get in speaking one-on-one with a CEO. But obviously, you're not actually allowed to get any real information from those meetings. It should all be in the public domain. And also, CEOs are very charming. When you look at the big kind of stock blow-ups that have hit Australian fund managers, generally there's been an extremely charming CEO that's brought someone in along for the ride, whether here or in an offshore company. It's not a charming CEO that you trust doesn't necessarily translate into whether people are buying or selling a particular product. And the people that are best at kind of, hoodwinking you often tend to rise to the top of these roles. So I think it's a very weak kind of data point. It's a weak way of kind of assessing companies. What is exciting and undeniable is if you see a company whose web traffics go through the roof, who climbs, Alexa's Amazon or Amazon's Alexa web rankings, or Google Trends search traffic is going up, and everybody's raving and tweeting about it. And you can see all these things, you can track them, and its revenue's growing every quarter, and you can see that people are spending more time on the app or whatever it is. That's the data. That's the exciting bit. And that's what we try and find. And if we find it, there's a good chance we'll be buying that company.
I've also read that you like to chat to former employees of companies, talk to suppliers and that network around them. Do you get similar data from them? Is that about access?
Yeah, well, I think, again, you have to remember who you're speaking to. So if you're speaking to an ex-employee that's left a company, there's a good chance that maybe the leaving of that company has tainted the way they view it. But you often get a bit of insight into that you just can't get from reading annual reports. I think the way of thinking about it is you're trying to figure out why people make the purchase decisions they make. So why do you pick one product and not another? Why do you use PayPal and not Afterpay or vice versa? Why do you sit down at this restaurant or not that restaurant? Trying to zoom in on that decision-making point is what we're trying to do. And the more kind of data points you can get on that, the more likely to get the answer to that right.
You mentioned some of those data sweepers and things like that. Is that something that you implement in your strategy? Do you get the data from the company or do you kind of have other tools?
Look, you can pay for really accurate data. I think if the stuff you get for free is pretty good, website rankings, Google Trends. Yeah. What you don't want to be doing is competing at like the margins. So, for example, there's like Gibbet data, which it's just a firm, but they basically track every car sale. There's a number of online car dealerships like Carvana, which we own, who that's very relevant for. Like you can literally see every car sale and where it was sold and by who. So you can basically track revenue for particular companies. And this Uber data used to come out every week. And then people started gaming that. Because every week when it came out, the market would move. And so people started replicating that and trying to trade ahead of that. And that's precisely the sort of arms race we want to avoid.
So too much data could be a bad thing.
Yeah, we just want to make sure they're all on track. If they're on track, if the web traffic's growing and revenues are growing, you want those big things to be working and not to get shaken out of a position because something small went wrong or you picked up some minor detail.
Great. I did want to circle back because I felt like I cut you off a little bit when you were talking about some of the big ideas, things that did work and didn't work. Were there any other sort of big ideas that you're thinking about at the moment?
In terms of big ideas, there's a few interesting thematics. We talked about life science, the way that's also effectively becoming a data science. It's possible for people to take the genetic code of a virus, say in the coronavirus case, and then build a vaccine off that. Like that's
pretty
new.
impressive.
That's really new. Yeah, it wasn't something we were able to do a few years ago. There's a few kind of buzzwords that we try and avoid. Things like 3D printing, things that like sound cool and innovative, but are actually really capital intensive and are unlikely to lead to a good kind of business outcome. There's really exciting things like space, which will no doubt be a great thing, but it's still quite early on. It's very hard to invest in that kind of space. Sectors like software run really hard. So those things went from kind of 6 times sales to 30, 40, 50 times sales, even 100. And they've kind of dropped, those multiples have dropped by a third. They're still really high. And so they were the best performing companies, or many of the best performing companies. It's funny because everyone was trying to decide which software company to own, but really they almost all did that. All the good ones did anyway. But that won't happen again. You can't do the same thing again.
Okay, let's dive into some case studies. Can you tell us about some of the stocks that you think are winners at the moment and why?
Yeah, good question. So there's a few. I guess our largest positions are still e-commerce. They're probably down about 30-40% from their highs, but they've probably done 3-4 times since we bought them. They're kind of like geographical leaders. So one's C, which is in Southeast Asia, kind of like number one in countries like Indonesia. They also have a thriving gaming business that's focused on effectively developing world. So games that are spec'd for kind of lower spec iPhones, designed for lower spec iPhones. Maintaining 100% revenue growth. And e-commerce in that part of the world is typically 4 to 5% of total commerce, which is a fraction of what it is elsewhere. So those companies could grow for a decade. Another one is Mercado Libre, which is an equivalent position in South America. What else are we buying at the moment? There's a couple of interesting companies that we're looking at that are quite spicy, so I wouldn't recommend anyone goes out and buys them. But they're kind of exchanges in Asia that are building social communities around trading. If you think about the Reddit phenomenon in the US, there's companies in effectively China that are building communities and encouraging people to trade. The interesting thing about that is, one of them came out with 350% revenue growth on it.
Are you buying the trading platform or the social network there, or
effectively they make money from the trading, but they also have asset management, so it's kind of like an online broker, effectively. But, they might have a few 100,000 paying customers and 14 million, social media, or people on the social platform. And so the players obviously convert that 14 million into paying subscribers and then growing that 14 million as well. And because there's a community, there's more of a lock-in than there is in a typical broker where it's kind of like lowest fee wins. So they're interesting. And again, it's a tough one because, the strongest data point for us is that revenue growth and the fact they're growing user numbers and the fact that the users are spending more and more. And you can see that community growing. Like that's what we're basing that decision around. We're considering it the strength and the quality of the business around the strength and quality of those particular numbers.
A lot of ultra growth stocks associated with the Cathie Wood of the world. What do you think of her investing style, and does it sort of inspire you, or does it kind of take you in the other direction?
Yeah, I mean, she's done an amazing job. Before her, there was really nobody, no large investor that was investing this way. Bizarrely, seeing as our entire lives and for the last 100 years have been a story of, or longer than that, has been a story of technological development. She markets extremely well, and she's stayed invested through some intense bouts of volatility. If you think about her core holdings in things like Tesla, that was really good investing. She really got it right, and she held through all the criticism and all the volatility. So there's a lot to like. I'd say what we do differently is Cathie Wood seems quite interested in investing in almost anything that is innovation focused. A lot of things that sound really good, but a bit further away from actually delivery. Whereas we're really only interested in things that are already delivering, that are basically already working.
Tell us a little bit about starting up your own funds management business. What's that process been like?
I think it took many years to actually get any traction whatsoever, but I think that was probably good. I think you do need to prove yourself. I think kind of had a bit of bad luck. So think about a fund manager. Let's say a fund manager has 10 years and you have 10 different returns for all those years. If you have your best return in the first year and your second best in the second year, you have a completely different trajectory of your entire fund. Whereas if you have your worst year in 10 in the start, then it's a bit of a disaster. And that's basically what happened to us.
Tell me about that.
So we launched in mid-2018 and then basically went straight into the first rising rate environment of this fund and knocked, small caps down 30%, and we were down a similar amount very shortly after. So you literally just convinced like a handful of people to give you money, and then 3 months later you're down 28%. It's tough, And then we kind of recovered and got some calls right. And some of our best performers, like we owned Afterpay, but Carvana, Pinduoduo, some of the software companies we owned, like we bought at those moments under pressure. So then we kind of recovered through 2019 and then went straight into coronavirus. And obviously that was a 40% correction across the board. We had companies that dropped a lot more than that. So after a year and a half, you're basically posting negative returns. So that's, a really bad start.
It's a tough track record to market, no doubt.
Yeah, well, I think the challenge was, the more that we simplified, the better we've gone, both in terms of returns and in terms of investors and growing the business.
What do you mean by simplified?
Well, we used to hedge, we used to short. They're probably the two biggest ones, mostly short. So in 2019, we should have done a lot better. Like if you look at how well our stocks did, and you look at our performance, we actually underperformed our stocks. And the reason for that is we were caught really short at the start of the year, at the lows. And then basically took those shorts off kind of halfway through the year, and said, actually, we don't want to do this anymore. It kind of been a decision that's been a long time coming. And then went straight into coronavirus, the sharpest sell-off. So it seemed like we got everything wrong and we'd made that call at the wrong time, but it ended up being a huge blessing in disguise. Because what we did is we'd simplified the strategy down. We knew exactly what we were doing. We had a defined process for how we were going to manage those downturns. Namely, if the companies are growing and doing a great job, we're going to hold them, like that's simple. And then that outperformed, I imagine, all the short sellers and market timers, all the people who looked smart for like a brief period of time. Just staying invested the whole way down was the right strategy. And then the second part of that was we also just stayed invested the whole way up as well. So there was a moment I vividly remember we're up 20 or 30% and the market was still down 20. So it was huge outperformance that we got in 2020. And we decided, what do you do in that? So a lot of, older, more experienced people were kind of coming and saying, now's the time to take the money off the table. Clock the win, put it. But if you think about what is the optimal strategy over 20 or 30 years, it's not to do that. You cannot sell your stocks every time the market crashes. You also can't sell them every time they go up 20%. If you're going to lose a lot of money if you sell every crash, and you're never going to make any money if you sell every time they rip. The actual optimal strategy is to stay invested if you're thinking in those long-term timeframes.
That's interesting, because I think a lot of people think about ultra growth and they kind of think it's a get in, get out, make it a quick turnaround play, but you're actually saying it's a long-term investment.
Yeah, definitely. I mean, the best companies that have these kind of true love and explosive growth, they grow for years and years and years. They can really maintain it. Every quarter they'll be bigger, better, and stronger. And that's a profile we've seen again and again and again, whether it's Afterpay, Shopify. These companies, Twilio, these companies the share prices will bounce around. There's all kinds of speculation, and sometimes they've made a mistake and the market's hating on them, or they rip and the market's loving them, and the stocks are bouncing around. Every quarter, every update, just bigger, better, and stronger. And that's kind of the profile we want across our entire fund, and that's basically how we'll manage both those big sell-offs, like March last year, and we're kind of in a bit of one now. As well as how we'll manage those really long periods where markets just are sideways or slowly grind up. We'll just keep coming back to the fundamentals. Is the company itself still killing it? If the answer is yes, then we'll keep holding.
That's great. I want to know a little bit about yourself and your family. So your father, George Frazis, is a heavyweight in his own right. Has he been sort of an inspiration to you moving into finance, or is there a bit of healthy competition between you two?
I wouldn't say there's healthy competition. I'd say I probably got a lot of help from him. So he's very focused on education. He's pretty demanding around performance as well. Like you need high grades. Like nothing, it's not acceptable not to get high grades.
Fair enough.
But I think that's actually how he looks at business as well. You should be performing. You need to hit your numbers. It's always that. Like there's so much politics involved in big organizations, but it really comes down to did you deliver? And the better you deliver, the better you are. And I think this game is like that times 1,000. Because all you really have is your performance, and you can't really hide. No matter how well you kind of pitch, if you've done 8% a year since inception, that just is what it is. So I do like that kind of focus on numbers and performance, and I think he would agree.
And outside of your family, are there any sort of people in the investment world who inspire you, or you like their investment strategy?
The people that inspire me are the people that invest and then just sit, because it's so hard to do. Like there's somebody that bought a few shares in Shopify IPO, like a fund manager, hasn't sold a single one. I admire Kathy Wood, the way she's kind of built this innovation space into an entire, category. She's done a very good job. There's some really good West Coast tech investment firms, but they're extremely well resourced now. So they'll have web scrapers that kind of go through and can see, sales almost by the minute. In Australia, I guess a lot of what we do has a lot in common with venture capital. I guess the difference is that our companies are probably a lot more mature. They're already delivering. We're taking less risk that they'll deliver. But there's firms like Blackbird, which you'll be aware of, they've done an extremely good job. So they're very impressive locally. And I've got a few friends that are kind of my age. So Amina, who works for Grok, works for the Cannon Brooks family. She's very good. A friend, Ben Barzak, is also very good on the software side. So there's a few local people around as well.
And so what's next for you, Michael?
This is kind of it. Like, we just want to try and,
Just keep killing it.
Hands are full with the fund, I mean, now, what's happening now? There's been a huge growth sell-off. Fund managers have gone from max overweight tech to seemingly max underweight tech. It's hard to believe, but there's multiple data points that show they've swung the whole other way. Everyone has piled into cyclicals and sold their tech. The ownership of FANG is now as low as it's been in I think the fund manager survey. I think they're underweight by more than they've ever been, those kinds of companies. So to me, when you see those extremes, it's so obvious. I don't want to say anything about the future is obvious because anything can happen. It seems obvious that they're just going to underperform now structurally because those companies that are underweight are growing faster and generating more cash and doing much better. So now's actually a really interesting time in that regard because we're down probably about 3 or 4% for the calendar year to date, but a pretty big draw from the heights of February. So our job now is to go through every single company and make sure, does it have that explosive growth? Does it have the customer love? We just went through reporting season. We've got an amazing snapshot into every company in those sectors. We really were just running the rule over every company we own and making sure they have those characteristics. And that's kind of the focus right now.
Michael, tell us, with all this optimism, all this, strategy for growth, is there anything that scares you?
Look, there's things that would hurt us in the short term, that's for sure. In many ways, something like the coronavirus crash, it was as severe as almost any in terms of the drawdown, but it was very short. A long, extended 2 to 3 year bear market, that would be a grind. We are not going to short, we'll stay invested throughout that. I think that'd be very difficult to communicate to clients, and it'd be a real test of the strategy. But the good thing about the companies we own is the fundamentals are improving extremely fast. The company's growing at 6 or 7% every month. So even in situations where the multiples halve, like they basically just did, we can often be flat over that period. But it is something that will almost certainly happen in my career in the next 20, 30 years. If you think about it, there will be a moment where interest rates rise. Software multiples, for example, will come down from 30 times back below 10 times. At some point that will happen.
Do you tap into any of the fear and the macro conversation around inflation as well at the moment?
Yeah, I mean, I'd say particularly for our company, the companies we invest in, but also other tech stocks, generally they have net cash, so they won't be hit by rising interest rates. They're also they're not very labour intensive. In fact, they have some of the highest revenue and profits per employee. So rising wages, which is good, is not actually going to hit them very hard. It's the opposite. And they all have exceptional pricing power. So they'll actually be able to lift their prices in line with, and actually, if the past is any guide, well in excess of inflation. So those kinds of inflationary environments are actually pretty positive. And it's deflationary environments that are scary. You mentioned before, think about what can really go wrong. So I got family in Greece. Actually, firstly, I lived in the UK for most of the last decade, and they had a very different experience at the end of the financial crisis. So they had an austerity movement, and they sacked people. They cut government programs. So people getting fired from their private sector jobs, and then they're also getting fired from public sector jobs. And all these people just, wages went down. You could almost feel, the UK get poorer as time went on as due to these policies. Then you saw a more extreme version of that in Greece, where I've got family and saw firsthand. And there you've got that. It was worse. The Greek experience over the last 10 years was worse than the Great Depression, in terms of output loss, in terms of unemployment. It basically went from being it was almost like a Western country to something, it was such a backwards movement. And it's horrific to see that, and it lasted for, 10 years. It's only just kind of recovering now. They're pretty horrible environments, but they were deflationary. They were cost cutting. There were things not happening, people getting fired. Today's environment is the opposite. The inflationary environment that we have now is just different. wages for the most disadvantaged people, people with criminal convictions, with, disabilities, things like that. As labour markets tighten, it disproportionately benefits them. And you're also seeing like people who are lower income earners, it's disproportionately benefiting them as well. And I think that's actually triggering a bit of a consumer boom, which is also benefiting like the companies we invest in. So you think about it's very easy to get caught up in these inflation things, but they're actually really complicated. And what's far more frightening is a horrific deflationary 10-year recession or depression.
Some people compare, our recovery in the GFC, that time of austerity, to how we recovered from COVID, which was almost the complete opposite.
I'm so glad that debate is probably decisively settled now. That was absolutely the right decision. Everybody lined up from left wing to right wing to regulators. Everybody just supported each other in the system, and we had one of the fastest recoveries to possibly the worst shock. That was just like bang, commerce just stopped for a few weeks and everyone stayed at home. It's hard to imagine anything worse happening, and it was completely fine due to a very kind of, what's the right word? Relaxed policy response, strong policy response.
Yep.
Yeah, imagine if, and I remember thinking about this last year, I was like, is anybody going to start talking about austerity? Is anybody going to start saying, we're spending too much? And there was a little bit of a mumble about it, but nothing serious. But I think that would have been frightening. That would have completely changed the tone of the recovery. And if you started hearing that again, that would probably bode pretty poorly for future returns in the markets as well.
I think that's everything. So thank you so much, Michael. It was really great to chat with you today.
Enjoyed that.
Really insightful advice and ideas, and I feel really energized about, the growth sector. Thank you.
Thanks, really enjoyed that.